Hey traders, Richard here, and welcome back to another price pattern video. Right, this is going to be the fourth triangle formation that I'm going to be talking about today, and the fourth and the final one. If you remember from the previous videos, I went through symmetrical triangles as well as ascending and descending triangles and shown some live examples. Just as a quick recap, all of these triangle formations have 5 internal waves, and they're labeled A, B, C, D's, E's, and then you get a trend continuation. So they're trend continuation type pattern. Symmetrical triangles can form in both bullish or bearish markets, whereas your ascending triangle typically forms during bullish markets, so it's a bullish continuation pattern, whereas a descending triangle forms during a bearish market, or typically, not always, but in majority of cases, and it is a bearish continuation pattern. So the fourth and final triangle of this family that we're going to be looking at today is called the expanding triangle. Right, there's an actual example right below these drawings I made here that I'm going to zoom into, and we're going to have a look at the characteristics that this triangle tends to display. All right, so this is the fourth and final one. It's also very well known as, or commonly known as, a megaphone pattern. All right, let me zoom into this actual structure or price pattern. This formed a little while ago on the NASDAQ. Again, this could appear in any market and any time frame. One thing I want to say about the expanding triangle formation, that it's a typically very volatile type of formation. And just as it ends, it typically shoots in the opposite direction when you get a trend continuation, also pretty aggressively. Now, they also typically form during very volatile time periods. This could be economic news events, geopolitical situations, wherever the case might be. All right, so here we have a beautiful example of an expanding triangle. I just want to get my trend line out here. And if I have to go and mark that for you, you see that, let me get that lower one out for you. It typically displays a megaphone type of shape or look or feel to it, right? Now, what makes this different than your symmetrical triangle or the other ones for that matter is that once price gets into a, let's say, high or low, it could also form during bullish or bearish markets. You get your internal waves actually expanding above and below the previous highs and lows, right? Giving you that classic expanded triangle look or megaphone pattern look. And then just as abruptly as this one ended, which is a beautiful situation or example, price made a low and it shot straight up back to the upside again. So a very volatile pattern. And again, all of the internal waves are also labeled A's, B's, C's, D's, and E's. They then end, and then price moves in the opposite direction. Now, with the symmetrical triangle, all your internal waves, you had more of a contracting type of price action towards the end before you had a breakout. There were Fibonacci ratios where price, or these ABCDs and E's, would typically end, typically at your 0.618 or 0.786, or sometimes 0.5% Fib ratios or retracements. Now, when it comes to actually the expanding triangles, because of their very volatile nature, they just typically go above or beyond the previous highs and lows of the internal waves where they ended, right? Now, they could typically extend to 1.618, 1.786, sometimes 200% of the previous wave. But they are just a bit unusual to try and say for sure they're going to stop at, let's say, 1.618 or 1.786 or whatever the case might be, expansion ratio. So just what you should take home with this is that you just have to look, and again, I said this during the previous videos, look at the overall shape and form of the actual pattern, and rather try to identify where a starting point might be. And if you start seeing price, let's say in this case, make a low, it makes a new high, fails to break above the previous high. Well, it actually breaks above the previous high, sorry, but it doesn't continue, or the trend doesn't continue upwards. You then get an abrupt end, price drops lower, it then breaks the previous low in this case. It fails to continue to the downside. Then you have the same thing, price goes up again, and this will actually be your D wave. it actually breaks or wicks above this previous highs. It could have closed above the previous highs. Doesn't necessarily only have to be a wick. But again, it just stops in the middle of nowhere. Price reverses strongly back downwards. This is typically what you'll get with expanding triangles or these megaphone patterns. As this pattern progresses, price action typically becomes much faster and more volatile, which is exactly what happened here. Price then ended, or sorry, this pattern then ended at an E wave. Let me just quickly mark out those internal waves for you. As price moves up, you always go the first wave lower. Mark that as an A. That would be your B wave, C wave, all of them extending above or below the previous wave's high. It'll be your D wave, and then you had your final E wave. And boom, price moves straight back to the upside again. All right, so again, the expanding triangles or megaphone patterns can form both bullish and bearish markets. So as long as you just know what the characteristic is and try to focus on the actual look and feel or shape of the triangle, and also look at the price action or behavior of price action during the formation, hopefully then taking the knowledge or what I've shown you here can then help you better identify this particular pattern the next time you are trading, and hopefully it benefits you in your trading journey. All right, so that was the expanded or triangle or the megaphone pattern. Again, the fourth and final triangle of the triangle family. All right, thanks for watching. Hope this information helps, and I'll see you in the next one. Take care and goodbye.